Good afternoon, subscribers, and welcome back to this GCSE Economics playlist. And you'll know that we've been looking at the current account specifically with reference to figure 1. And today I want to just maybe try to link that to what appears in figure 2. So you will be well aware, I'm sure, let me just roll this on for us, be well aware that figure 2 then moves into the exchange rate. And I hope now at this stage in your GCSE economics course you will know and appreciate, keyword there, appreciate, nice little segue, that there is a link between the current account, exports and imports, and the exchange rate and the movements in the exchange rate. Now that could prove to be quite significant when it comes to potential questions for this exam paper. So that's what we're going to have a look at today. Interestingly, we had a guest speaker to school just last week from the Bank of England, and one of the things that he was talking about was the whole notion of a weaker pound. We'll say a little bit about that later, but the way in which that impacts the price of imports and hence the price of things in the shop. So you can see from this graphic that £100 today buys $20 less than it did in November 2015 and €30 less than it did in November 2015. So even though, and in spite of the fact that the price of goods and services in shops may not be changing, the exchange rate movements can ultimately impact the price of goods and services. So let's just have a look at this little example, ladies and gentlemen, which hopefully will maybe help to clarify this for you. Let me just change one or two things around here. So here we have just a simple little table where we have the exchange rate, pound sterling, UK pound sterling, and the United States dollar. And we're setting up here with an exchange rate of £1 will buy 10 US dollars. Okay? Now, you can use this very easily to illustrate how this impacts the price of exports and imports and hence the subsequent demand. So let's have a little think about this. I'm using the example of a car here. Nice drawing. Art was never my forte. So a car being produced in the UK, let's say for the sake of argument, to keep things nice and simple, a car in the UK costs £1. Now, at an exchange rate of £1 to 10 US dollars, how much will it cost the American to buy that car? Well, obviously, it will cost them 10 US dollars because that is the exchange rate. 10 US dollars will buy £1 worth of UK good or service, and hence it would, at that exchange rate, it costs 10 US dollars. Okay. Now, of course, the exchange rate is not static and it's constantly changing against the USD. So what might happen? Well, let's look at this. £1 to $10. Let's say that a day later, it's now £1 buys 20 US dollars. So £1 buys more US dollars. Now that, ladies and gentlemen, we would be referring to the fact there that the pound has got stronger because it's buying 20 US dollars worth of goods and service rather than 10. So that's a strengthening of the pound, the opposite to which has been happening in the UK, also known as an appreciation of the pound. Now, what would happen then? The car coming out of the production line, let's say at Nissan, close by, still will be £1 for the sake of argument. But because the exchange rate has now moved, it is going to cost the American twice as much. It's going to cost them 20 US dollars rather than 10. And so let's think about what you call a good which we would ship out to America. That is, of course, known as an export. So as a consequence of the pound strengthening, getting stronger or appreciating, the price of the export gets more expensive. So the UK car, instead of costing 10 US dollars, now it costs 20. So the export gets more expensive. So when you think about this, and the value of the pound going upwards or downwards, the export price is always moving in the same direction as the currency. Now what do I mean by that? Well, if the currency gets stronger, the export price goes up. If the currency gets weaker, the export price falls. And this is just a very simple, straightforward illustration of that. Okay, now let's look at it from the other side of the Atlantic, as it were. Let's consider America producing goods which we buy. Now, if you've been looking on the news this morning, you'll see that President Trump, he's having a little temper tantrum at the moment in terms of trade with regard to washing machines. So here we have a US washing machine, ladies and gentlemen. Well, I'm telling you that the washing machine costs 10 US dollars. Now again, how much would that then cost for us to bring into the UK, so to import in from the United States? Well, at this exchange rate, £1 will buy us 10 US dollars worth of goods. So in other words, it would buy us this washing machine. So at that exchange rate, the US washing machine, which is priced at 10 US dollars, we can get it for £1 because of the exchange rate, 1 to 10. However, let's say that it now is more expensive to buy £1 worth of UK goods. So you need more US dollars to get £1 worth of UK goods. Now in this case, that means that the dollar is getting weaker because it's going 10 to 1 to 20 to 1. And of course you'd expect that because we've already explained that the pound was getting stronger. Well, if one's getting stronger, the other one has to be getting weaker, the flip side of the same coin in that respect. So, previously, we could buy the washing machine for £1 at this exchange rate. And now the exchange rate has changed. The pound has strengthened. The pound is buying more US dollars. At the same time, the same way of saying that is that the dollar has weakened. How much is this going to cost us now? Well, now in the UK we can buy 20 US dollars for £1 because the pound is stronger. Well, the washing machine, it's still $10. So actually, if we paid £1 to the United States, we could get we could get 2 washing machines. Or, if we only wanted one, which is the norm, if we only wanted one, then if £1 buys 20 US dollars, 50 pence half of that would buy us 10 US dollars. And so the import from the United States would only be 50 pence. And so the import is cheaper. And again, ladies and gentlemen, I say to you, that is the flip side of the same coin. We've said here that when the pound gets stronger, then the price of the export, the UK car going out, that gets more expensive. But of course, imports and exports, in the same way as strengthening and weakening, are the same side of the flip side of the same coin, rather. And so, as a consequence of this strengthening of the pound, if exports are more expensive, the opposite effect is that imports are less expensive, as illustrated by this little example. So I hope that's clear, ladies and gentlemen, and I hope you can see, therefore, potential questions coming up with regard to the pre-release material, where you're going to be asked about exchange rates, and you'll probably be asked about the relative impact on exports and imports and the subsequent demand. And obviously I'll follow that up in videos to come. But I hope that's clarified that, ladies and gentlemen, with regard to export prices, import prices and the exchange rates. The key thing, ladies and gents, is of course that the price in the UK or the price in the United States, they're static, they're not changing. But it's because the exchange rate is changing that inadvertently impacts the price of the export and the price of the import. Okay, ladies and gents, if this is your first time watching a G-Economics video, thank you for watching. Thank you for watching to the end, really appreciate it. If you click the subscribe button beneath, That'll obviously make sure that you get all the up-to-date videos. Obviously, if you ring the bell and put your alerts on, then you'll be notified immediately when the new videos come out. If you've got any questions, do email me, hello@geekonomics.co.uk, or you can contact me via my website, geekonomics.co.uk, and I'll be more than happy to answer any of your questions. Bye for now.